Ever seen someone post a screenshot of their portfolio and wonder how they actually got rich off the stock market? Ever stared at your bank account, watched it earn basically nothing, and thought, there has to be a better way? Well, today we're going to break down exactly what stocks are, how regular people use them to build real wealth, and why understanding this one concept could change the entire trajectory of your financial life. So, what exactly is a stock? In the simplest terms possible, a stock is a tiny piece of ownership in a company. When you buy a stock, you're not just betting on a number going up, you're literally buying a slice of a real business. Pretty wild when you think about it that way, right? Let's make this easier to picture. Imagine your favorite company is like a giant pizza, cut into thousands or even millions of slices. Each one of those slices is called a share. When you buy a share, you're basically walking up and saying, "I'll take that slice, please." Let's say a small coffee brand decided to split their company into 10 total shares. If you owned 2 of those shares, you'd own 20% of that coffee brand. In the real world, big companies split themselves into millions or even billions of shares, so your slice is usually much smaller, but the idea is exactly the same. You own a piece of something real. Now you might be asking yourself, why would any company want to sell pieces of itself to total strangers? That's actually a great question, and the answer comes down to one simple thing: money. Building a business is expensive. Companies need cash to open new locations, hire employees, build products, or expand into new markets. They have 2 main options. They can go to a bank and take out a loan, which means paying that money back with interest. Or they can sell shares of their company to investors. The beautiful part for the company is that money from selling shares never has to be paid back. It's simply theirs to use and grow the business with. Let me tell you a quick story to make this click. Picture a guy named Eli who dreams of opening a chain of gourmet burger trucks called Smoke and Stack. Eli has done his research and knows he needs $80,000 to get his first 3 trucks built and running. The problem is, he's only managed to save up $32,000 on his own. Instead of drowning himself in a bank loan, Eli decides to split his business into 10 equal shares. Since he's putting in $32,000, he holds on to 4 shares for himself. Each share is worth $8,000. That leaves 6 shares up for grabs. A woman named Priya hears about Eli's burger truck idea through a mutual friend and instantly believes in it. She buys 2 shares for $16,000, which means she now owns 20% of Smoke and Stack. With Priya's investment and 4 other investors jumping in, Eli finally has his $80,000 and gets his trucks rolling. Fast forward 4 years, and Smoke and Stack has absolutely blown up. Eli now has 12 trucks running across 3 cities, and the business that started out worth $80,000 is now valued at $400,000. Remember Priya, who put in $16,000 for her 2 shares? Her 20% stake is now worth $80,000. If she decided to sell today, she would walk away with a $64,000 profit. That's the kind of math that gets people excited about investing in the first place. But here's the part nobody likes to talk about. What if Smoke and Stack had gotten crushed by a new competitor, and the business value dropped to $40,000 instead? Priya's 20% stake would only be worth $8,000, meaning she'd have lost more than half of what she originally put in. That's the other side of the coin, and it's just as real as the upside. This exact story plays out every single day in the real stock market, just with way bigger numbers and way more investors involved. Some companies also like to share their profits directly with their shareholders. This is called a dividend, and it's basically the company saying, "Thanks for believing in us. Here's a little something for being an owner." Now you might be wondering, where do people actually go to buy these little slices of companies? That happens on what's called a stock exchange. Think of a stock exchange like a massive marketplace where buyers and sellers come together to trade shares. The 2 most well-known exchanges are the New York Stock Exchange and the NASDAQ. You don't have to physically go anywhere anymore, though. These days, you can buy a share of nearly any major company straight from an app on your phone in under a minute. When a business gets big enough, like if Smoke and Stack eventually became a nationwide chain with hundreds of locations, it might decide to go public and list itself on one of these exchanges. That's the moment when literally anyone in the world can buy or sell a piece of that company. Now, here's something most beginners don't realize. Not all stock is the same. When companies issue shares, they usually come in two main types: common stock and preferred stock. Think of them like general admission tickets and VIP tickets to the same concert. Both get you through the door, but the experience is different. Common stock is what most people picture when they hear the word stock. When you own common stock, you get voting rights. That means you actually get a say in major company decisions, including who sits on the board of directors. 1 share equals 1 vote. 1,000 shares equals 1,000 votes. You might receive dividends as a common shareholder, but they're never guaranteed. If the company has a bad year, those payments can disappear completely. The biggest advantage of common stock is growth potential. If the company takes off, your shares can climb dramatically in value. The trade-off is risk. If the company ever goes bankrupt, common stockholders are last in line to get paid, which sometimes means getting nothing at all. Preferred stock works a little differently. It's like the more cautious, responsible sibling of common stock. Preferred shareholders usually give up their voting rights entirely. In exchange, they get something most people actually want, which is a guaranteed dividend. Preferred stockholders get paid before common stockholders, and those payments tend to be fixed and predictable. If you're someone who wants steady, reliable income rather than a wild ride, this is the more attractive option. If the company ever collapses, preferred stockholders are paid before common stockholders, although they still stand behind anyone the company owes actual debt to. You can think of preferred stock as sitting somewhere between a stock and a bond. Less risky than common stock, but with a lower ceiling for growth. So which one is better? Honestly, it depends entirely on what you're trying to accomplish. If you're chasing maximum growth and you can stomach some risk along the way, common stock is probably more your speed. If you'd rather have predictable income without the stress of constant ups and downs, preferred stock might fit your style better. Now let's get to the real question. Why would anyone choose to put their money into something that can lose value when they could just leave it safely in a savings account? The answer is growth. A typical savings account might pay you 1 or 2% a year if you're lucky. The stock market, historically, has returned somewhere around 7 to 10% per year on average over long periods of time. That difference might not sound huge on paper, but over 20 or 30 years, it completely changes what your money becomes. Of course, that higher return comes with a trade-off. The stock market can feel like a roller coaster. Prices go up, prices go down, and sometimes they swing hard in both directions within the same week. Some investors play the long game, buying shares in companies they believe in and holding on to them for years or even decades, letting that growth compound quietly in the background. Others try to move faster, buying and selling more frequently to catch short-term price swings. Both approaches exist, and neither one is automatically right or wrong. It really comes down to your goals, your patience, and how much risk you're comfortable carrying. Here's the thing. People who actually get wealthy through the stock market understand. They're not gambling on a random number going up. They're buying ownership in real businesses that make real profits and real profits. When you buy stock in a company, you're choosing to bet on that company's future. The clearer your reasoning behind that bet, the better your odds of coming out ahead in the long run. This is exactly why so many financially successful people talk about investing early and investing consistently. It's not about timing some perfect moment or finding a secret stock nobody else knows about. It's about understanding the businesses you're buying into and giving your money enough time to grow. If you're serious about building real wealth, the lesson from Eli, Priya, and every other investor out there is the same. Start with companies you actually understand. Don't throw every dollar you have into a single stock, no matter how confident you feel about it. Spreading your investments around protects you from one bad outcome wiping out everything you've built. Wealth through stocks isn't usually built overnight. It's built slowly, through patience, consistency, and a basic understanding of how ownership actually works. The people who treat the stock market like a casino tend to lose. The people who treat it like buying small pieces of real businesses, the ones they believe in for the long haul, tend to be the ones who eventually look back and realize they actually became rich without ever noticing the exact moment it happened. That's the real secret behind almost every wealthy investor you've ever heard about. They didn't find some shortcut. They just understood what they were buying, stayed patient, and let time do the heavy lifting. If this video helped things click for you, drop a like and subscribe so you don't miss the next breakdown. And let me know in the comments what financial topic you want explained next.